य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते अस्मिन् लोकः अस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्द्वैता 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 एतद्द्वैता.
Faculty for the day, Senior Advocate, Gujarat High Court, Shri Saurabh Soparkar Sahab, President of CA Association, CA Rajubhai Shah, President Karnavati Club, Jayesh Bhai Modi, Secretary of the Branch, Nirav Bhai Choksi, Secretary of the CA Association, Dilip Bhai Jodhani, Chartered Accountant, CA Durgesh Bhai Buch. I would have specific mention because he is the person who coordinated for this beautiful venue so that none of our member is devoid of the opportunity to be enriched from this lecture of none other than Saurabh Bhai Soparkar, because whosoever and how many times do you listen to anybody, but till the time you listen to Saurabh Bhai Soparkar, the budget is not there for the members, for the chartered accountants. I am very happy that we are able to cater to all the chartered accountants who are coming to this venue. Friends, this budget had special hopes from the public at large and so as the professionals. And I am sure so many hidden opportunities are there for the professional as well as in this budget. May it be in terms of return filing, if there are delay in the due dates, yes, there would be penalties. So the people would be coming to you well in time. Friends, the only one thing that I'd like to share with you is now Ahmedabad branch has been made full-fledged DCO office. So what does it mean? It means that now all the issues of the members as well as students would be addressed from the Ahmedabad branch itself. We need not go to Mumbai or Delhi for the issues of the members. And in the first phase for the CPT, it has been started, and for CPT now the registration are being done at the branch itself and everything is being done over there only. In the next 10 to 15 days for IPCC and then for CA final, and maybe in the month for the members also all the activities will start. Now I request Jayesh Bhai Modi to please share his views with us. Thank you.
Good evening, everybody. It is indeed an honor to have the most respectable professional people at this club. I would like to welcome somebody whom I adore, somebody whom I look upon, who is close to me, a friend of mine who happens to be the speaker for today, Saurabh Bhai, who happens to also be the senior counsel in the High Court. He has been associated with this Karnavati club, has been helping us out in many of our matters so far. So Saurabh Bhai, a pleasure having you at the club as a speaker. I would also like to welcome CA Vikas Jain, who is the chairman of the Ahmedabad branch, who had come thrice to see that the facilities here are all right and had made even the smallest arrangement to see to it. Of course, the parking seems to be an issue that we all have to face in Ahmedabad. We'll have to live with it for the time being. I would also like to welcome the CA Mr. Raju Shah, the president of the CA Association, CA Nirav Choksi, secretary Ahmedabad branch, CA Dilip Jodhani, secretary of the CA Association. This happens to be a very important and intellectual meeting. This club normally is meeting with entertainment programs, program for fitnesses, And it is indeed an honor today to have an intellectual exchange taking place, making people understand where the country is going to lead, because the new systems of demonetization and trying to get this entire country into the digital mode is something that we all look forward to. And not taking much of your time, I thank you for giving me this honor to be with you.
Good evening, friends. Respected Sri Saurabh Soparkar, Senior Advocate Speaker for the today's program, Sri Jayesh Modi, President of the Kanavati Club, young and energetic Chairman of the Ahmedabad branch Vikas Jain, dedicated Secretary of the CA Association Dilip Jodhani, a smart and action-oriented Secretary of the Ahmedabad branch Neerav Choksi, dignitaries of the dais, invited guests, ladies and gentlemen. Friends, I take this opportunity to welcome you all on this wonderful evening for a talk on a technical aspect of the finance bill of 2017. Friends, I am sure you all will agree that without hearing this Saurabh bhai, it will not end for us to see the integrities of the amendments which has made in the finance bill. We heard some of the speakers. We have already seen the lot of the media's news. We have already seen the lot of materials coming in the our computers. But once we hear the Saurabh bhai, will definitely clear all our doubts and integrities of the amendment which has been made in the finance bill. Friend, as you know that the present government is always taking up bold steps. In the past, they have taken the demonetization of the notes, then the implementation of the GST, and this year they have done the budget also in a very unique way, that they have done on the 1st of February, because they wanted to start all the activities from the 1st of April onwards, friends. Even they have merged the railway budget with the general budget, and not only that, they have changed their paradigm shift from non-planned or planned expenditure to the revenue and the capital expenditure. I know that, friends, all the chartered accountants understand what is the revenue and the capital expenditure, and with that, how the transparency will be there in the government working, friends. The budget, friends, is a strong with the regard to the fiscal numbers and reforms. Many changes have been made for affordable housings and the rates in the tax rates. This would be whether it is helpful to the clients or not. I will definitely hear from the Saurabh bhai. Before I invite the Saurabh bhai, friends, at this stage I am happy to inform you that Chartered Accountant Association is coming out with a web application for the members, and this will enable for the members to pay online all the payments, even membership fees and the benevolent fund fees and everything. This will also help you to register for the events, and this will give you the reminder for the events, friends. This will be launched within just next week time, and so you all will be in a position to download that applications, friends. Like every year, this year also we have come out with the budget publication, and I would like to request Shailesh, be the chairman of the publication committee, and Abhishek Jain, the convener, and request to Saurabh bhai to unfold this budget booklet. At this stage, I would like to thank all the dignitaries who has helped us for completing this booklet. Ajit bhai, Ashok bhai, Ashwin bhai, Atul bhai, Pannani ji, Chintan, Mukesh bhai, Neerav, Jayesh bhai, Jignesh bhai, Puneet bhai, and Rajni bhai, friends. Thank you, Saurabh bhai. I will now to request Neerav Choksi to formally introduce the Saurabh bhai. Thank you, friends. Sir, please, please. Sir, for the benefit of some other members, please.
I believe that if at this stage I need introduction, then I am wrongly here and you are wrongly here. because you would be here either to listen to me or you are just going around and then you feel it's a good place to sit. In either situation, I don't think introduction is necessary. Anyway, Mr. Chairman, Mr. President of the club, and dear friends, it's a pleasure to be here this evening again to share some of my thoughts on the Finance Bill 2017. But before I really go there, I must compliment the team which has made this booklet possible. I am aware of the efforts that go in making of this booklet. Every member who has contributed for this booklet needs to be complimented and congratulated, because it is for their untiring efforts, this would not have been possible within such a short notice. With this, let me now go to the issues proper. I should be finishing within, according to the timetable on the stage, I should be finishing within 90 minutes, so let me not spend more time on issues other than what we need to discuss. Finance Bill 2017 has brought in 87 amendments. Some of them are in fine print and some of them contain multiple amendments. So if I were to narrate each one of them, I would not be able to finish even reading them, much less discussing them. So as I usually do, I will skip all those amendments which I believe are not worth discussing, not because they are worthless, but because they do not really generate controversies which require some resolution in this august body. So I will not be going into every amendment, I will be going into only some of the amendments, about 35 in number. But before I really even go there, a little historical background would be necessary. This is the year where for the first time we find the government is publicly acknowledging that the people of this country do not comply with the tax laws and something drastically needs to be done. Let's look at the figures. Figures are very startling. We have 13.94 lakh companies registered in this country. Out of 13.94 lakh companies, only 5.97 lakh filed returns of income. In other words, more than half even do not file returns of income. Out of 5.97 lakh which file return of income, 2.76 lakh show either nil income or losses, which would mean you have less than 3 lakh companies which are paying tax, and as all of us are aware, companies don't enjoy basic exemption. Even if you have 100 rupees income, you have to pay tax. There are only about 29,000, less than 29,000 companies in the whole country which show income of more than rupees 1 crore, and only 7,781 companies which show income in excess of rupees 10 crore. In the whole country, less than 8,000 companies which show income of more than rupees 10 crore. Let's go to individuals. There are 3.78 crore non-corporate assesses. Of that 3.78 crore, 99 lakh, almost a crore, do not have income above rupees 2.5 lakh. So they are outside the net of the tax department. 1.99 crore people have income between 2.5 lakh to rupees 5 lakh in a year. So you are left with 76 lakh SSEs, 72 lakh SSEs. 52 lakh of them show income between rupees 5 lakh to 10 lakh, and it is only 24 lakh people who show income in excess of rupees 10 lakh. And if you find out the number of people who show income in excess of rupees 50 lakh all over the country, it is 1.72 lakh. All these numbers, 1.72 lakh individuals showing income of more than rupees 50 lakh, or 7,781 companies showing income of more than rupees 10 crore, that becomes material when you know that during the last year we sold 1.25 crore new cars and 2 crore people went abroad. So 2 crore people went abroad, and the total number of SSCs who have income above rupees 5 lakh is less than 1 crore. Now tell me, how can you afford to go abroad if your income is not even 5 lakh of rupees? Therefore the finance, and these are the figures given by the Honorable the Finance Minister, which would show that something needs to be done very fundamentally for the purpose of bringing people to pay taxes. Let's look at the other perspective before I go to the clause by clause analysis. Post demonetization, in 1 crore 9 lakh bank account, an amount in excess of rupees 2 lakh was deposited. Between 2 lakh and 80 lakh, 1 crore 9 lakh bank accounts. On an average 5 lakh 3,000. And in more than 1.48 lakh bank account, 1.48 lakh bank account, amount in excess of rupees 80 lakh in cash is deposited, on an average rupees 3.30 crore. So here is the cash which was hidden, which suddenly surfaced and got deposited in the bank account. And though the number of such accounts, as I said, are almost 1.12 crore, the government says we have been able to identify 18 lakh accounts which we are going to scrutinize as against normal 4.5 lakh scrutiny every year. This is the problem that we have, namely a complete apathy to obligation to pay taxes. The idea has been, therefore, in this budget to bring in more and more economy on the table by ensuring that the transactions are reflected in the books in the banking system, and cash transactions are either completely eliminated or to a significant extent made difficult. When I go to the amendments proposed on the demonetization or post demonetization, we'll see this in greater detail. But the point that I was trying to make out was, this finance bill addresses the issue probably as to how to bring out these kinds of things on surface so as to ensure that more and people are caught if they do not pay the taxes correctly. With this preliminary comment, let's now go to the clauses proper. The first simple one, known to all, therefore I will not go into greater detail. Now you need not pay tax if you are individual or HUF, if your income is not rupees 2.5 lakh but up to rupees 3 lakh, because the first slab is brought down from 10% to 5% up to rupees 5 lakh. So there is a marginal concession of all those who earn income between 2.5 lakh to 3 lakh, no tax. Between 3 lakh to 5 lakh, the rate of tax will not be 10% but 5%. As opposed to that, if you are an individual or HUF and if you have income in excess of rupees 50 lakh, you are liable to pay surcharge at 10% of your tax. Persons who earn income in excess of rupees 1 crore have always been paying surcharge since last 3-4 years. In fact, surcharge in their case is 15% of tax. But persons who earn income between rupees 50 lakh to rupees 1 crore did not suffer surcharge. Now a surcharge is being introduced so as to see that some additional tax is being imposed on them. Government had to give some concession. Ultimately, it is a year of election and 2019 is also not very far away. There was also a promise that on corporates front, the rates of taxes will be brought down. So the proposal is that in case of companies of which turnover is not exceeding rupees 50 crore in the financial year 15-16, so nobody can juggle around with the turnover, nobody can make adjustments. If in the financial year 15-16 your turnover did not exceed rupees 50 crore, the rate of tax, so far as the companies are concerned, would not be 30%, it will be brought down to 25%. A good move, but look at a couple of complications which will arise. I am a small company, my turnover is less than rupees 50 crore, but I was not even born in 1516, I am a company incorporated in 1617. If a company is incorporated in 1617, its turnover may be, let's say, rupees 30 crore, it will pay tax at 30%, as opposed to a company which was there in 1516, born or earlier, of which turnover was less than rupees 50 crore. In 1617, its turnover may be 200 crore. But yet, it would be entitled to benefit of reduced rate of tax of 25%, whereas a person or a company which has much lesser turnover may still end up paying tax at a higher rate. In order that people do not fudge around with their accounts and do not show turnover below rupees 50 crore, government picked up a historical year, and because you pick up a historical year, what happened post-history, current 1617 got lost. So this year if you start a company, you have no advantage. If you had started a company in 1516 or earlier, and if your turnover was below rupees 50 crore, in that year, you have an advantage. Take the second anomaly. I start a company in 1516, somewhere in the later half of the year, let's say in January 16, I start the company. My monthly turnover is rupees 10 crore. Yearly turnover will be 120 crore. But I started the company in January 16, so for 1516 my turnover is below rupees 50 crore. And because it is below rupees 50 crore, in the current year, my turnover is rupees 120 crore, or maybe more than that, I still continue to enjoy the benefit of reduced rate of 5%. These are anomalies. I am not saying the finance minister would have any desire to promote this, but then probably if you keep provided that explanation, clauses whereby this will be covered, not covered, probably things will become very complex. So maybe the Honorable Finance Minister decided to take a blow. Fine, if they take advantage wrongly, let a few companies take advantage wrongly, but I would still give benefit to majority which deserves it. So this is one advantage given to the, so to say, small and medium-sized companies. Sometimes it may as well happen that some companies which are of such size will not get benefit, and some companies which are of a larger size may still get benefit, but barring those exceptions, it's a welcome move. There is one proposal. Next amendment is under section 242 capital A, holding period. 242A defines as to what should be the holding period for the purpose of qualification of an asset to be short-term versus long-term. All of us are aware, in case of a land and building, so far the holding period was 3 years. Now, in order to give a boost to the real estate, in order to see that people can easily sell away the real estate and make money and still not be required to pay significant tax, though looking at the current market rate of real estate, probably everybody would have lost. But assuming that market rates go up and people will start make money, now the proposal is that if you have land and or building, and if you sell that, even if you held it not for 3 years but for 2 years, it will be a long-term capital gain. A welcome move. But look at what's likely to be the problem. Again, problem created by the SSs themselves in past. In past, there were situations where in relation to land and building, certain provisions were there. For example, section 50 capital C. If you sell land and building at a price below the Jantri rate is deemed to be the consideration. SSs argued in such a situation that if I have not land and building with a full-fledged ownership, but I have truncated ownership, I am only a lessee, I am only a licensee, or my right is encumbered by something else, what I am selling is not land and building, I am selling an interest in land and building, and persuaded some of the tribunals to accept the argument that land and building is distinct from interest in land and building. Now all those arguments which were made by the SSs to support the case there will hit back the SSs now. If you sell within 2 years, beyond 2 years but within 3 years, what is not a pure land and building, but only an interest in land and building, probably revenue would show the judgments in your favor given earlier that look, what you are selling is not land and building, what you are selling is interest in land and building, which is not equivalent to land and building, and therefore you do not qualify to get benefit of a long-term capital gain. It will be a short-term capital gain. In my view, all the decisions which take a view interest in land and building is not equivalent to land and building with respect are not correct. I would take a view land and building would include interest in land and building because the whole would always include a part. But till a higher forum takes a view, subscribing to what my view is, please be careful if you are selling not land and building but interest in land and building. If possible, see that 3 years period is over. Otherwise, you are likely to have a problem of department denying you the status of a long-term capital gain on the ground. It is not land and building, it's an interest in land and building. One amendment which is a small but which has a very far-reaching effect. But we must understand the historical background and the perspective of the government. Penny stock. In fact, if you ask me today, there are three or four major financial frauds on tax fronts which have been played by some people who are rightly called the entry operators. The capital whereby huge monies will be given with huge premium. The second would be of penny stocks. The third would be data entry management changes. We will not go there. Let's concentrate on penny stock. What is penny stock? People found out that you can manipulate the stock market. So what happens? I want to convert 1 crore of rupees official from my black money. There are people in the market who are, and when they are caught, and I've read some of their statements, they accept we are entry operators. There are people who are entry operators. You give them rupees 1 crore in cash, they will allot you officially share worth rupees 1 lakh. The share which will be allotted to you would then be traded on the floor of stock exchange. At the end of 1 year, because at the relevant time 1 year was the holding period, 1 year, the price of the share would not be 1 rupee per share, it will be 10 rupee per share, so or 100 rupee per share. So against rupees 1 lakh that I have invested on paper, the investment is worth rupees 1 crore. So I will sell away the share for rupees 1 crore. It will be a long-term capital gain. I have sold away the shares on the floor of stock exchange. Section 1038 would apply. I will not pay tax. You would ask me, but I have sold shares to someone. Why would someone buy a penniless, a worthless share for rupees 1 crore? Because then 2 months thereafter, he will sell away the share back at rupees 1 lakh. Market will crash and he will claim loss of rupees 99 lakh. So I get a gain of rupees 1 crore on which I will not pay tax. He will claim a loss of rupees 99 lakh and claim as a deduction. This has been engaging attention of the government left, right and center. And there are few thousand cases going around in the country. But probably government finds that still we need to resolve the problem. So by one stroke of pen, amendment that is proposed is, if you sell shares of a listed company on the floor of stock exchange, and if you want to claim long-term capital gain as exempt under section 1038, you would be given the benefit if and only if when you acquired the share, you had paid security transaction tax. In other words, you had acquired the shares on the floor of stock exchange. So if I acquire the shares on the floor of stock exchange and after some time or some years I sell away, I have no problem. But if my acquisition originally is not on the floor of stock exchange, I get no benefit of section 1038, gain is wholly taxable. Which would mean all those entry operators who had given the shares initially by way of private placement, now they have a major problem because all those shares which are allotted to a person on a private placement basis, even if you take the share price from 1 rupee to 100 rupees, the gain that the shareholder would have is going to be taxable. There is now no exemption. Therefore, the whole game of creating bogus long-term capital gain on listed share that is now taken away. By one stroke of pen, I must compliment the government because this was required to be done. But then there are serious problems. In an amendment of such a sweeping nature, what happens is, when you are trying to caught the scoundrels, in the process, you also catch up people who are honest people. આપણે ગુજરાતીમાં કહીએ સુકા જોડે લીલું ભળી જાય. That's exactly what's happening. The language of the provision is, if you have not acquired the shares originally on payment of security transaction tax, you do not get the benefit at all. Therefore, take a situation. I hold 1,000 shares of, let's say, Reliance. Let's say I am getting bonus shares on the 1,000 shares held by me. Not that Reliance is declaring bonus, I am not spokesman for Reliance. Now, bonus shares I have acquired not on payment of security transaction tax, because they are bonus shares issued. Which would mean when I sell the bonus shares on the floor of stock exchange, though it's a completely legitimate transaction, I will still not get the benefit. So if you have acquired the shares as bonus shares, as right shares, or take a genuine case, somebody starts a company, floats a company, the first generator promoter, company is doing very well, so from private it becomes public, from public it becomes a listed company. 10 years down the road, he sells the shares. Part of it originally amount invested by him. Even then he is caught because originally the shares are acquired at a time where there is no payment of security transaction tax. Mr. A dies. He has purchased the share on payment of STT. He dies. Shares are then received by his son. When the son will go to sell the shares in the market, his acquisition is not on payment of STT. Mr. X gives shares as a gift to Mrs. X or Mr. Y, whoever. The donee resells the share in the market. His or her acquisition is not on payment of STT. He or she again will not get the benefit of 1038. I must very candidly say, government is not mindless and government is not aware of this problem. Section itself says, barring those cases which will be covered as excluded by a notification. So we await the notification. If in notification they exclude all genuine cases, I have no problem. But my experience is, as is the experience of all of you, that it is not as if government considers all genuine cases as genuine, and there are occasions when even genuine cases would not be fully covered under this. So you have a problem if it is found that yours is a genuine case and yet it is not covered by that exception notification. It is as yet not issued, so I do not know what is going to be the exception. But your case is not, if it is not covered by that notification, then the whole benefit of section 1038 would be lost to you. Second, assume that you are, as a matter of fact, purchaser of share, and assume that you purchase from the floor of stock exchange. Assume therefore you are entitled to benefit. In order to claim benefit, you will have to prove before the assessing officer that your original acquisition was on payment of STT. I must clarify, STT has been introduced only on 1st October 2004. So shares acquired prior thereto are not obviously covered by this. But let us say I acquire some shares in the year 5, 6 or 6, 7. On payment of STT, I know I purchased on the floor of stock exchange. I sell today. Assessing officer will tell me, yes, you are claiming as a long-term capital gain. Show that these shares were acquired by you in the year 5, 6 or 6, 7 on payment of STT. Who keeps record of purchases made years back to be able to prove that I had paid STT? In fact, before I came over here, I checked up with my share broker. Is it possible from my Demat account to find out whether what I had acquired 10 years back was on payment of STT? What he told me was, in the current statement it will not be shown, but in the statement of the month in which you had acquired the share, it will be found out that you had paid STT. So A, I must find out in which month I had acquired share. B, I must request my depository to give me statement of that month. C, I assume that he has the statement. And D, if I have that, I will be able to prove. Otherwise, how do I prove that what I acquired 10 years back did bear STT? Therefore, this is going to be a practical problem. It is not very easy to say, okay, if I paid by STT, what is the problem? There is going to be problem because you will be required to establish that you had purchased the shares on payment of STT. Therefore, the provision, though introduced with good purpose, is likely to hit some people knowingly or unknowingly in a manner which is going to cause some inconvenience. I go now to the next amendment, section 10AA. There has been a controversy going on between the SSCs and the department on how to compute benefit of section 10A, 10B, 10AA, etc. Let's say I have two units, one eligible for section 10AA benefit, another ineligible. I have profit of rupees 100 in eligible unit and loss of rupees 40 in ineligible unit. Do I claim exemption of rupees 100 and carry forward loss of rupees 40 of ineligible unit to next year? Or do I need to compulsorily set off 100 income against 40 loss, have net income of 60 which is eligible, so I don't pay any tax, but in the process I lose the benefit of carry forward of loss of rupees 40 which is in any case ineligible. The controversy was going on. Ultimately, very recently, it got settled before the Supreme Court in the case of Yokogawa, India, by judgment of 16th December 2016. Supreme Court said SSCs are right. If you have a loss of 100 of 10AA and profit of rupees 40 on non-eligible unit, you will have loss of rupees 40 in non-eligible unit, you are right to say 100 rupees of my 10AA profit is exempt, 40 rupees of loss will not be set off, it will be permitted to be carried forward. Law is now sought to be nullified by amending from assessment year 1819 this interpretation by saying if you have profit under section 10AA and a loss otherwise, you will be first required to set off and only on the balance amount you will get the benefit. Whether government should or should not have done it, I really have no problem. It's their prerogative, maybe they were justified in doing it. But our problem is something else. This government had an avowed policy not to bring in retrospective amendment. This is technically not a retrospective amendment because as I said, it is to come into play from assessment year 1819. However, and this is where the whole problem starts, the amendment says, for the removal of doubts, it is hereby declared that then loss will have to be set off. So I would not be surprised if assessing officers say, yes, this is from AY 1890, but look at the language used, for the removal of doubt, it is hereby declared. Choice of the expression for the removal of doubt or it is hereby declared normally leads one to conclude it is declaratory law, and if it's a declaratory or a clarificatory law, it is well settled that it will apply to all pending proceedings, it will apply to even earlier years. So I would not be surprised if some zealous officer takes up a position that notwithstanding the Supreme Court judgment in favor of the SSC, I still hold that by virtue of the amendment, now the position is clear, SSC is not entitled to carry forward the loss, it needs to be set off against 10AA. Now, why do I say it is most unfortunate government attempts in doing this? Such a controversy arose before the Supreme Court in the case of SEDECO Forex 279 ITR 310. And in SEDECO Forex, again there was an amendment under section 10A. Again it used the language for the removal of doubts, it is hereby declared. And revenue said for the removal of doubt, it is hereby declared would mean amendment must be taken to be retrospective in nature because it is clarificatory. Supreme Court said it is clarificatory provided there is some confusion. Who has the confusion? Once Supreme Court clears the law under Article 141 of the Constitution of India, that's the law of the land. Once Supreme Court said the set-off is not required to be done, matter ends. There is no question of any second view, other view, clarity required, confusion. If this is the position Supreme Court has taken, that even if you use the expression for the removal of doubt or that it is hereby clarified, if there is no confusion so far, You can't create a confusion for the purpose of holding that the amendment is retrospective or retroactive in nature. Now, if this is a settled law that you cannot bring in a confusion by using this language, why should government unnecessarily create complication by opening up windows of the avenues of litigation? I am conscious of the expression used by the Honorable Chairman over here, hidden opportunities of for the chartered accountants in his opening remark. But I am sure no chartered accountant here really wants to have this kind of hidden opportunity of having a litigation which is a completely mindless litigation. Supreme Court has resolved and yet government says we'll keep this pending because now amendment says for the removal of doubts it is hereby clarified. So this is one problem. Subject to that, this is an amendment which is to take place from a future date. 3 amendments are suggested in case of a charitable trust directly, and 4th will come indirectly. Indirectly, I'll go at the appropriate place. 1. Today, one charitable trust is entitled to give corpus donation to another charitable trust, and if it gives corpus donation to another charitable trust, the amount of donation given so far would be regarded as application of income in the hand of the donor trust. Now, in the hand of donor trust is an application of income. However, in the hands of recipient trust, because it's a corpus donation, it will not have to pay tax. The government said we don't want to have a situation whereby the donor gets a deduction, donee does not pay tax. So now the proposal is that if a trust from out of its current income gives corpus donation to another charitable trust, then that amount would not be regarded as application of its income. All of us are aware a charitable trust has to apply 85% of its income, can set apart at least 15%, but otherwise it has to apply 85% of income in this year or within the prescribed period. Therefore, now a charitable trust would not be able to reduce its tax liability by giving corpus donation to another trust. That is not to say you are prohibited from giving regular donation or revenue donation. Therefore, if I were the donor trust, I would say, I am giving donation to you. I need not say it is a corpus donation. Donee trust may take it as a corpus donation on its own, or even donee trust may not take it as a corpus donation, but it will have an obligation to use up the money within the prescribed period. So it is not as if heavens are going to fall and now trusts will have to start paying tax. The donor trust will not get deduction if it is a corpus donation. It will have to give regular donation, in which even donee trust will have to ensure that it will spend up the money within prescribed time, failing which donee trust will have to pay tax. But then principle is that you cannot now give corpus donation and claim it as application of income. Second, not very significant, nonetheless required to be discussed. If a charitable trust duly registered with the Commissioner of Income Tax changes its objects, what happens is a problem. Today, at the stage of registration of a trust, the objects are being verified. Good enough. Later on, if the trust changes the objects, that is not directly within the control of the Income Tax Department. For the purpose of cancellation of registration under section 12AA3, the only test is the activity of the trust is not being carried out in accordance with its objects. Which objects? Not necessarily original objects, even the new objects. Therefore, the department was finding a little piquant situation, little odd situation. Objects, let's say there is a set of objects, A set of objects are approved, then A is converted into A plus B. A plus B is not approved by it. The trust is doing object activity of object B, and department can do nothing about it. So now the proposal is, whenever a trust changes its objects, within 30 days, it will have to intimate to the commissioner or the under section 12AA, and like registration originally, within 6 months, the commissioner will decide whether with the amended objects, the trust needs to be given registration or not. In other words, with the change in object, you need to seek fresh registration. If you do not, then you are not regarded as a registered charitable trust, meaning thereby you will not get benefit of tax exemption. The third, slightly confusing, under section 139(4)(a), every trust is required to file its return of income. But then it does not prescribe the time limit within it, it has to be filed. So now the proposal is that you have to file your return of income under section 139(4)(a) within the time allowed under that section. Now this is where I have little confusion. Time allowed under that section. Now if you look at section 139, different times are allowed in different situations. 139(1) prescribes the own due date. 139(4)(a) does not give the due date. If there is already a return of income and if you are permitted to file revised return, again there is a different 1 year from the end of the assessment year, so on and so forth. Probably they should have said is within the due date, then there was no problem. Or they should have said before the end of the assessment year. Again there would have been no problem. But they have not specified which date. It has kept it open-ended. I am sure somebody might bring it to the notice of the finance ministry, and therefore by the time the bill is made into an act, probably appropriate corrections will be made here. There is something to be said about electoral reform, but I'll take slightly later when I take up the connected issue. Therefore, let me go to section 23. A small but important change. If you have a house property, income thereof on the notional basis, annual letting value is taxable. Now, if you are a builder, it's likely that you may have a large number of flats or properties which may not have been sold by you because you are unable to find the buyer. What happens in relation to a builder developer who has got scores of properties which are lying vacant, which is stock in trade for it, but it is still lying vacant? Is the builder developer required to pay tax under section 23 on the annual letting value of his stock in trade which is lying vacant? I would have said logically there was no need for the builder to pay tax. But law is not, no logic, Income Tax Act certainly is not logic. Delhi High Court in the case of, recent judgment in the case of Ansar Housing 389 ITR 373 took the view that whether you are a builder or whether you are an investor, whether you are individual or otherwise, section 23 applies. And therefore if you have 100 flats or 1,000 flats which are lying vacant, on one hand you are unable to sell your flats. And on the other hand, on that 1,000 flats, you would have received, let's say, rupees 2 lakh of income every year. So rupees 20 crore, you must pay tax. Now, obviously, this was adding insult to injury. There must have been a strong representation. So now they have amended the law, or there's a proposal to amend the law in favor of SSC to a significant extent, not unlimited. What is proposed is, if an SSC is holding real estate as stock in trade, and if that real estate, one or more flats, building, etc., whatever, is not occupied any time during the year, is not let out any time during the year, then for the period of 1 year after the building occupancy certificate is available to the builder, for that 1 more year, no tax on the annual letting value on a notional basis. Therefore, let's say I have got 500 flats which I have constructed, and I am unable to sell out of 500 flats, 300 flats in year 1. Out of 300 I have sold 200 in year 2 next year. Then for the remaining 100 flats which I have, I will have to pay ALV, tax on ALV. But in the year in which I have got occupation certificate, plus 1 more year, I don't have to pay tax on this notional income. A good change. It could be 1 year, it could be 3 years, it could be a matter of argument. I am not questioning the wisdom. Only thing is, people have got very fertile minds. And I am apprehensive that if a builder doesn't want to pay tax on ALV at any point of time, he will not take occupancy certificate at all till he finds the buyer. So till he finds the buyer, he will not take occupancy certificate. Until he does not take occupancy certificate, this amendment protects him. But like all good amendments which are likely to be misused, maybe this may be misused by some, there is no reason why others who are legitimately entitled to it should not get the benefit. That takes me to a series of amendments on account of this demonetization. Some of them are important, some of them are not very important. First, little simple but important nonetheless. Today under section 40A3, if I'm a businessman and spend any expenditure other than an account pay check or account pay bank draft, or as is now obviously accepted by RTGS, of a sum in excess of rupees 20,000 on a day, the amount is not allowed to me as an expenditure. With demonetization, with more and more money being required to be brought into the banking circle, with people being encouraged, forced, compelled to use the banking channel for the purpose of entering into all legitimate transaction, the limit is being brought down from rupees 20,000 to rupees 10,000. So you cannot have a cash transaction in excess of rupees 10,000 on any day, otherwise the amount will be disallowed as an expenditure. Let me clarify, there is a second proviso to this provision under which payment up to rupees 35,000 per day to transport operator is permitted. That ceiling is not being brought down. So to transport operator you can still pay up to rupees 35,000 per day, but otherwise the limit is now rupees 10,000. That's amendment 1. Amendment 2. So far, cash payment was prohibited from being considered for deductible expenditure only in relation to revenue expenditure, section 37 read with 40A3 or 40A3 read with all other earlier sections. Courts had taken a view, and correctly because the section was very clear, if I spend any money on a capital expenditure, section 40A3 did not hit me. Which would mean, suppose today I were to buy plant and machinery worth rupees 50 lakh in cash, hypothetically, department can do nothing to me. On 50 lakh of rupees, if I paid cash, they would still be required to give depreciation to me. Now the proposal is that even in relation to expenditure incurred for the purpose of acquisition, installation, etc. of plant and machinery, when the definition of actual cost is there under section 43(1), a proviso is being introduced that if there is on any given day an amount in excess of rupees 10,000 is spent for the purpose of acquisition or installation of plant and machinery, etc., the same will be ignored for the purpose of actual cost. In other words, you cannot claim depreciation. Therefore, I have acquired a machine of rupees 20 lakh, paid by check, no problem. That machine is being installed in my factory, and I ask someone to make the floor, some electrician to come to start the machine, and I pay to the person, contractor, rupees 15,000 in cash, or to the electrician for the purpose of making electrical system, rupees 12,000 in cash. Though it's a legitimate expenditure, the same will be ignored for the purpose of claim of depreciation. You shall have to make payment only by account paid check, bank draft or RTGS. Third, we have a provision which is a hybrid, which is neither capital nor revenue, section 35 AD. Under this provision, in case of certain specified businesses, the very expenditure including capital expenditure is allowed as a deductible expenditure. For example, if you start a hospital with up to 100 beds, then the very cost of the hospital, except for land, goodwill and cost of financial asset, everything including cost of building, plant, machinery, furniture, beds, everything would be allowed as a deductible expenditure under 35 AD. The same provision is made applicable there. So if you have a claim under 35 AD, again in order to qualify for the claim, you must ensure that on a given day, you have not ended up paying more than rupees 10,000 to one person so as to make it a claim allowable under 35 AD. Fourth, if you give cash donation and if you are claiming exemption under section 80G, you must not make the donation in excess of rupees 2,000 because any cash donation in excess of rupees 2,000 would be prohibited. Fifth, electoral reform. Today, every political party's income is totally exempt under section 13A in relation to political donation. The requirement is if the political party is in receipt of donation in excess of rupees 20,000, then full details of the donor are required to be maintained. Now, the proposal is that if a political party receives donation in excess of rupees 2,000, the same shall be only by an account paid check, account paid bank draft or RTGS, or as they are now introducing a new concept of electronic bond. There are people who want to give donation to political parties out of compulsion or out of their own ideological reasons. But the problem is that if they give donation of rupees 10 lakh to, let's say, party A, party B, party C, party D, all of them will compel the SSC donor to give equivalent, if not donation, to their own parties. So there is always a reservation in giving donation officially, because then it is recorded in the books of the respective parties. So now the proposal is, whoever wants to give donation to political parties of a significant amount will buy electronic bond, which is like anonymous donation slip. And from that, you will buy it by check. And then from that bond, you will pass on the money to the respective political parties. So there is no record in the books of the respective political parties as to who is the person which has given donation, so that the donor is not harassed by the other political party. Only problem over here is, under the Companies Act, you are still required to give in your accounts name of the party to whom you have given donation. So unless they bring in corresponding amendment of the Companies Act, this is not going to be solved, because by and large donation will be from companies. So even if the company buys electronic vote, electronic donation bond, nonetheless, if in the books of the company it is required to be disclosed and disclosed to the world at large by printing in the balance sheet, the secrecy would be lost. Nonetheless, this is one major change, a good change, electoral reform, that you can't give donation more than rupees 2,000 in cash to any electoral party. One more in relation to this, covered up with the electoral parties. Now every electoral party will have to file return of income on or before the due date for filing return of income, because they are usually having very bad memory about the obligation to file returns of income. For months, sometimes for years, they are not filed. Now the law is very clear, they have to file it in time. The last change on demonetization, which I believe is the most important change, and which, if taken to its logical end, is likely to change the economy or the way in which people start behaving, is now no person shall receive. Please mark, so far every prohibition was on the payer. Now the prohibition is on the recipient payee. No person shall receive an amount of rupees 3 lakh in cash or other than by account pay check, account pay bank draft or RTGS in 3 situations. 1, in aggregate from a person in 1 day. When I read this, I thought, okay, I cannot receive in 1 day, so today I'll take 2.5, next day I'll take 2.5, third day I will take 2.5 lakh. But the government is not stupid. So let's look at the next one. In respect of the single transaction. So in respect of single transaction, not on 1 day. If there's a transaction, you might receive rupees 2 lakh today, 2 lakh after 1 month, 2 lakh after 3 months, 2 lakh after 7 months. But if there's one transaction, the moment you cross limit of rupees 3 lakh, you are out. So from one person on 1 day, or in respect of single transaction, or in respect of transactions relating to one event or one occasion from a person. So I have a marriage in my home, at my home. I employ a caterer. There are 3 dinner functions. I will say each dinner function is a separate function. So I'll pay him rupees 2 lakh in cash for every function. No, you are not permitted to do that, because it is in respect of transaction relating to one event. Event is marriage, not the dinner. So if there is one event resulting into multiple obligations to make payment, multiple obligation together should not result into receipt of more than rupees 3 lakh in cash. And what happens if it is received? What happens is, you are liable to pay a penalty of the equivalent amount. So take a situation like this. There is a search at the premises of a builder, and it is found that builder has sold flats, let's say, and it has received cash of rupees 20 crore. It will have to pay tax on 20 crore, no issue, no dispute there. Apart from paying tax on rupees 20 crore, it will now have to pay penalty worth rupees 20 crore. A builder is caught, a jeweler is caught, a caterer is caught. These are avenues where people end up spending a lot of cash. And these are avenues where people can easily pass on cash. Those people should now really be scared in accepting cash. Because if they are not scared and if they are ultimately caught with cash receipts, those cash receipts will expose them to tax liability, which in any case is understandable because these are transactions on which in any case you are liable to pay tax. It will expose them to tax liability, it will expose them to interest, it will expose them to penalty, it might also expose them to prosecution for not showing correct income. But people are feeling nonetheless I will still get away with it because of their own problems, because of the own way in which the assessments go on. Here, not only you end up paying tax, interest, penalty, prosecution, on the receipt itself, you will end up paying penalty of an equivalent amount. Yesterday, somebody raised a very interesting question to me, and frankly, I must say, I was puzzled because what he said was right. If I withdraw rupees 5 lakh from my own bank account, am I hit by this? I am receiving money in excess of rupees 3 lakh in cash. I am prohibited. Probably that is not the desire of the government. Probably they'll clarify that if you withdraw money from your own account, there may not be a problem. But the way in which the section is being drafted is so drastic that suppose somebody searched and at the time of search from one locker rupees 10 lakh is found in the name of the father, and the father says 10 lakh is, yes, it's official money. Look, 2 lakh is withdrawn from my account, 2 lakh is withdrawn from my wife's account, 2 lakh is withdrawn from my first son, second son, son-in-law or whatever. 10 lakh is, this is the source of 10 lakh. Because you have received a sum in excess of 3 lakh, why should you not be penalized and you will have difficulty in giving answer? This is one provision which, if the government appropriately enforces, I would take a view, might change the mindset of people in doing business. If people, in spite of this, do not improve, only God can save us. Because if this is the kind of the treatment which is now being given to receipt of cash, then obviously government probably will take a position that nobody is required to be spared who is found to be indulging into unaccounted income. These are the changes on demonetization, which, as I said, are likely to have far-reaching consequences in the times to come. Let me now move on to other amendments. Section 36(1)(7)(a) permits a bank to claim provision for bad and doubtful debt up to 7.5% of its income. With NPAs, with all the problems in collection, etc., this 7.5% is being raised to 8.5%. Not a very important change, nonetheless, for banks it's important. But for cooperative bank, there is a surprise change, which in any case was required. Every bank is required to make accounts in accordance with the guidelines of RBI. RBI says if the bank account is NPA, you cannot take the credit of the interest which you will debit in the account of the borrower who is a defaulter. Now, whether interest debited on the account of defaulter is an income or not, interest income or not, became a matter of controversy. Supreme Court years back in State Bank of Travancore took the view 158 ITR 102 on the real income theory. It's an income. Later on, slightly different view was given, but nonetheless it was said it is an income. In order that these kinds of receipts which are not likely to be realized do not end up being taxed, Section 43D was introduced with effect from 1st April 2000, whereby it was stated that for banks, such interest would be taxed on cash basis. So only in the year in which you will receive money from the defaulter, you will have to pay tax. So the banks were happy with 43D. The problem was, at the relevant point of time, cooperative banks were enjoying exemption from the tax liability under Section 80P. So they were not worried that they are not listed in Section 43D. In the 2007, Section 80P is amended. Under Section 80P4, the exemption from the cooperative bank is withdrawn. But at that time, government forgot that if you make cooperative bank now taxable, you must also extend benefit of 43D to the cooperative banks. So cooperative banks were liable to pay tax, but they were also liable to pay tax on interest which was not likely to be realized. Albeit this came to be challenged before Gujarat High Court, challenge is still pending. In the meantime, Gujarat High Court, I must say, interpreted very wisely the guidelines of RBI, and in the recent judgment 289 CTR 225, Shri Mahila Seva Sahkari Bank took the view that though 43D is not available, they are not liable to pay tax on such receipts. Now all these controversies are put an end to by amending 43D and by saying that even a cooperative bank would be eligible to take benefit of section 43D. In other words, even a cooperative bank would be liable to pay tax on such interest, doubtful interest, only in the year of actual receipt. But just as 43D is being amended, 43B is being amended, which is certainly a cause of concern for the businessman. Hitherto, if you have borrowed money from a bank, which is a commercial bank, not a cooperative bank, outstanding interest is not allowed to use a deduction unless you actually make the payment. So outstanding interest was disallowed in your returns of income. This was not applicable to cooperative banks. So if you borrow money from a cooperative bank, even if you have not made the payment, you can still claim deduction on accrual basis. Government says that if in the hands of cooperative bank, we are extending benefit of 43D, we will correspondingly withdraw the benefit in the hands of the payer, interest payer, and now we will say that so long as interest is not paid to a cooperative bank, you are not entitled to claim deduction. I am not finding fault with the government's logic. I am only indicating that now even section 43B stands expanded to cover even a cooperative bank. Next set of changes are in relation to obligation to maintain books of accounts and audit. 3 changes. 1, under section 44AA today, you are required to maintain books of accounts if your income is to exceed rupees 1,20,000 or if your turnover or gross receipts is likely to exceed an amount of rupees 10 lakh. Government says it is too low a limit, so now you are required to maintain books of accounts if and only if your income is likely to exceed rupees 2.5 lakh instead of 1, or if your turnover or receipts is likely to exceed rupees 25 lakh instead of 10. Therefore, small traders, small businessmen, they may now not be required to maintain books of account if turnover is around rupees 2 lakh per month or income is less than around 20,000 per month. For compulsory audit, a question which is important for all of us, 44AB, now if there is an SSC of which turnover is below rupees 2 crore and who is going in for presumptive tax under section 44AD, which I'll immediately take up, he is not required to get the books of accounts audited. So if someone's turnover is let's say rupees 1.50 crore and is declaring income of rupees 15 lakh, then matter comes to an end. There is no need to get books of accounts audited. Therefore, to that extent, the obligation of audit is going to go down, the work might go down. Third, and this is again interesting because it also has demonetization flavor. Section 44AD is being amended in relation to presumptive tax. The law as per the last year's finance bill and the act was that if I have a turnover up to rupees 2 crore, presumption is that 8% of my receipt is my income. So if my turnover is 1.5 crore, my income is rupees 12 lakh. If I am agreeable with that, fine. If I am not agreeable, maintain books of accounts, so on and audit, etc., etc. On 31st of December, our Honorable the Prime Minister chose to be the Honorable the Finance Minister. And therefore, Honorable Prime Minister, in his address to nation, started giving concessions in the matter of the tax. I do not know how Honorable the Prime Minister was concerned. But he made a statement that the rate of tax is being reduced from 8% to 6%. And if the Honorable Prime Minister says, obviously the Honorable Finance Minister has to do it. So now the amendment is, for presumptive tax, it is being brought down from 8% to 6%. But then our Honorable the Finance Minister is also sharp. So he has added his own twist. And look at the twist. Presumptive rate of tax is 6% of your turnover, provided that turnover is in account paid check account pay bank draft or RTGS. So that part of turnover which is by account pay check draft RTGS, presumption is you have earned 6%. That part of turnover which is not by account pay check etc., presumption is you have earned 8%. You might go and tell your sir, here are my two invoices, I have sold to both of them at the same rate. Probably to cash I might have sold at a little lesser rate because I am getting cash today. That's not the answer. Answer is if you sold for other than account pay check etc., 8%. If for account pay check, 6%. So if my total turnover of 1.5 crore, let's say 1.25 crore is account pay check, 6%, 7.5 lakh. 25 lakh other than account pay check, 8%, 20,000. So I will have to find out at the end of the year what is account pay check and what is other than account pay check. Problem. Do I need to maintain photocopy of every check to show it's an account pay check and not a cross check? Because I have to prove it's an account pay check. Now, in India, obviously once I deposit check in my bank account, check is not with me. Check is with the bank, and in fact not with my bank, it is with the bank of the issuer. Suppose assessing officer says, sir, I don't agree that it's account pay check. You prove it's account pay check. During the year, I might have received, let's say, 500 payments. Do I ask bank or all banks in the country to give me photocopy of checks? Or is it safer for me to take out photocopy of every check before I deposit? Or somebody gives me cross check. I'll say, okay, don't deposit. First of all, let's put it account pay together. Because if we put account pay, I'll save 2%. These are interesting, on the lighter side, these are interesting questions which are likely to arise. I do not believe officers are going to be so unreasonable in stating. So ultimately the idea is that money must remain in circulation, money must come out of known sources of income. But again, this shows the mindset of government. Every transaction should be from a known source of income, should suffer tax, otherwise people will not get the benefit of lower or reduced rate of taxation. I now take up one issue which had been troubling many people in the matter of real estate. It's not very common in Gujarat, but it is common in rest of the country, especially north. Let's say I have a piece of land of 10,000 square meter. Its worth is, let's say, rupees 10 crore. I want to develop the land, but I have no money. Mr. A is a person who has money, who wants to develop the land, but he has no land. Today what we do is we enter into development agreement, permit him to develop, he'll pay payment to me eventually. But all of us are aware by virtue of the extended definition of the term transfer under section 247 clauses 5 and 6, there's always a problem of the transaction being taxable in the year in which development agreement is entered into. I might have received no money and yet I am liable to pay tax. In a later year, the agreement will be cancelled, there will be serious disputes between us, and yet, according to one view, I may still be liable to pay tax. So Bombay High Court recently, in the case of Lok Housing, has taken a view, you may not be liable. In other parts of the country, the normal arrangement is A contributes land, B contributes money, both of them will jointly develop. At the end of the project, both of them will share. Let's say the total development is of 50,000 square feet. A will say, I will take 25,000 square feet towards my contribution of land. B will say, I will take 25,000 square feet towards my contribution of money. And that's how respective party will sell. Question was, how do you tax this transaction? Now the proposal is, and how it is going to be used and misused. Proposal is, in case of a joint development, there will be no tax in the initial year. The tax will be only in the year in which project is complete. Now, let's go step by step. If there are conditions. First, there has to be a registered agreement with developer and the builder. Let's say A is the landowner, B is the developer. So, A landowner must enter into a registered agreement with B. The agreement must pay that B will have to give to A on development being complete, building or buildings with or without cash. I'll come to this little later. So A and B will share the construction at a later date. Then, if this is the kind of arrangement, the tax on the transaction would have to be paid by A, because A has permitted his land to be used by B. A will have to pay tax on this transaction only in the year in which the construction is complete and building use permission is available. Till that point of time, there is no obligation to pay tax. What happens if he transfers his interest in the project before the whole thing is over? If he transfers his interest before the whole project is over, in the year in which he transfers his interest, in that year he will have to pay tax, but not before that. A very good provision, excellent thought. What are the problems which government will face? SS will face no problem. I am A, I want to sell the land. I want to have pure cash. I am not interested in a single, let's say the contractor is going to construct 100 flats. I don't want a single flat. But if I say that I am giving you for cash today, for rupees, let's say 10 crore, I am required to pay tax on rupees 10 crore today. So the arrangement will be, you will give me rupees 9 crore 57, let's 9 crore and 70 lakh and one flat. Requirement is building or buildings with or without cash. So even one out of 100 flats, builder can keep 99, he will give one flat to me, which also eventually I may sell it away to him. So then it will qualify for this. Problem number 2 which government will have. Tax is to be paid only in the year in which the occupation certificate is available. What happens if I don't want to pay tax for a year or two? I will not take occupation certificate, because in this state, for selling a flat, occupation certificate has never been thought a necessity by any builder. Every builder, by and large, sells flat without even occupation certificate. And God forbid you never receive occupation certificate because there is a projection of balcony or there is illegal parking. As the language of the section goes, landowner will never pay tax, because occupancy certificate is never received. Until you receive it, you will not be required to pay tax. These are loopholes. I am not advising anyone to try them out. What I am telling is, look at the good intention of the government, but it is not reflected correctly. So what the government will now do is, provided that so far as, but it will not apply, it will have 7 exceptions and 3 provisos and 4 clarifications. In the process, it will mutilate the law in such a manner, probably no one can take advantage. That's the problem that we have. If you have a simplified section, people misuse it. If you have a complex section, nobody can ever use it. But this is what I believe. Subject to that, this is very good. A builder, a person may not be compelled to pay tax unless he has money. It's only in the year in which he will receive money, he will pay tax. From equitable point of view, I would take a view, this is one of the finest amendment that is being brought in. Another very fine amendment, a small but nonetheless a far-reaching effect. The base year for indexation is being switched from 1981 to 2001. Now, somebody can argue, but even if it is 1981, you still have the benefit of indexation from 81 to 2001. But look at the situation like this. Let's say somebody has a next door plot. If you find out the value of 1981, it would be probably in 2 digits. Even if you multiply it by index it today, that 2 digit will at best turn into 3 digit and not in 5 digit or 6 digit. But if you take 2001 value, it may not be obviously commensurate with today's value, but still it will be reasonably high to give you better benefit of indexation. So in case of real estate of areas which were not seriously developed in 80s and did not therefore have the benefit of significant value as on 1481, if you now sell that land or building, you will have far greater deduction because of index cost of acquisition, because 2001 is the base year. Apart from the fact that if 2001 year is the base year, then you will also be you will be in a position to get the valuation reports, etc. of 2001. 81 in any case is a very complex thing. I now go to again one change which is going to create immense complication. Section 50 capital CA. Today we have section 50C known to everyone. If I have land or building and if I sell it at a price below the Jantri rate, I am required to pay tax on the Jantri rate because that is deemed to be the consideration. 50C applied only to land and building. Now we have extension of that principle in relation to shares of a company which is not quoted. Therefore, let's take a case for the timing of unlisted share. We'll go to quoted part a little later. If I sell share of an unlisted company today, let us say at rupees 200 per share, today the law was it will be taken at the correct value. Department had no right to dispute it unless they knew as a matter of fact that I have taken more than 200. But otherwise 200 was the correct price. Now the proposal is, if you sell share in a year, the value of the share, fair value of the share would be found out on the basis of rule to be appropriately defined. Whether they go for rule 11 UA or they bring in some another rule, I do not know. On the basis of that valuation, I should have sold. If I sell shares at a price below that price, then by a deeming fiction, law will assume that consideration is not what I have received, consideration is what the fair value of share is. Therefore, let's say I sell for rupees 200, but the fair value comes to rupees 500, the law will say that I will have to pay tax on 500 and not on 200. Now, why is this a problem? I am aware there is no future and options except on ready delivery, but there are various kind of arrangements whereby people agree to sell share at a predetermined formula much in advance. A and B start a company. Both of them agree that in case if at a future date one of them wants to walk out, he will sell shares to other person at a predetermined rate. Nobody knows who is going to walk out, who is going to retain. Now if this formula is worked out, and if another formula price comes to rupees 200, but if according to the fair value it is 500, A will have to pay tax on 500, though there is no cash element. There could be a situation where, let's say I have floated a company, I am running it successfully, I now want to go for public issue. So what I want to do is I will offer my shares for sale on the floor of stock exchange for the purpose of listing. Now nobody might at that stage recover the full price of the share, because nobody would then buy the share. If you sell the shares at a price below the formula value, you will end up paying tax. A preference share may be converted into equitable share, as a result of which the price may be lower at the initial period, so on and so forth. There could be a variety of reasons as to why people may legitimately sell share at a price below what the government believes to be the fair price. Now, the law is, unless you charge the fair price, you will end up paying tax. The second complication is, what is the meaning of the term quoted? The term quoted is defined as quoted on recognized stock exchange with regularity from time to time. What is regularity from time to time? 10 quotations a day, 1 quotation every 10 days, 100 shares a day, 10,000 shares a day, matter of controversy. So, one, regularity from time to time, and quotation reflects current transaction in the ordinary course of business. So if the share is, let's say it's a listed share, but then share is, as is being regularly stated, played by an operator who will either take the share price to the skyrocket high or rock bottom, then it is not share which is, quotation is not reflecting the current transaction in the ordinary course of business. Then even that price may not be good. You might end up paying tax on value which is not actually received by you. Therefore, to that extent, you certainly have an issue. Section 56 is being amended. I will have to be slightly quicker, even if I want to go beyond 90, I will have to be slightly quicker. I'll quickly run through some of the uninteresting provision, but 56 is important. Section 56(2)(7) was introduced whereby if an individual or HUF receives for other than without any consideration or for an inadequate consideration immovable or movable property, for the difference they were required to pay tax. Then they introduced section 56(2)(7)(a) whereby they covered the companies and firms, but only in relation to shares of an unlisted company. Now 56(2)(7) and 56(2)(7)(a) Both are being replaced by 56 to 10. The fundamental difference is every entity is covered under 56 to 10 except one, a domestic company, and two, a trust which is registered as a charitable trust. So what is happening is, when a company is covered, except for a charitable trust, everyone is covered. So what happens is, let's say a trust other than a charitable trust, a private trust receives some money, a company receives some money, an AOP or BOI would receive some money. They would all now be required to pay tax on the income. Look at the problem. A charitable trust is exempt from the provision so long as it is registered. The moment its registration is cancelled, even that trust would be liable to pay tax under 56, which would mean all corpus donations, all capital receipts, all would be liable to pay tax on this. So by enlarging the scope of section 56, you have essentially required large number of people to pay tax on what is regarded as an artificial income. Section 71 says inter-head adjustment in relation to loss from income from house property will not be permitted beyond rupees 2 lakh, but if you have loss in excess of rupees 2 lakh, same can be carried forward for 8 more years. There's a minor amendment in section 79, I will skip that. I'll now go to 80 IBA because I still need to cover 6 or 7 important amendments, so let me quicken up. Section 80 IBA was introduced from assessment year last year for giving a boost to the housing sector. And if you have new housing project, whole income was totally exempt. 3 amendments are being suggested, which are all the 3 are good amendments. First, hitherto you have to finish project within 3 years. Now you have a right to finish up to 5 years. So you have a longer period to finish the project. 2, you are not permitted to construct about 30 square meter for Bombay, Delhi, Calcutta, Madras, or about 60 square meter elsewhere, which is a built-up area. Now that is being shifted to carpet area. All of us are aware the difference between carpet area and super built-up is sometimes as high as 40%. So 30 square meter will become 50 square meter, or 60 square meter will become almost 100 square meter. Third, the 25 kilometer periphery of Bombay, Delhi, Calcutta, Madras is being eliminated. So only if you are constructing in the cities, you have a problem. Otherwise, you can have reasonably bigger house. So 80 IBA is going to be made more popular by this particular change. 2 amendments are being, one amendment small, but I'll just quickly run through it. For specified domestic transaction, there is transfer pricing. Now they are eliminating one occasion for transfer pricing for specified domestic transaction, that is in relation to transactions between SSC and its AE, where it is covered only by section 48.2. In other words, if neither party is claiming any exemption from any of its income, no adjustment for transfer pricing provision would not apply. It's going to be a great boon to a large number of people. 2 amendments on international taxation, 92CE and 94B. To put it briefly, today if you have a transaction with your AE, if there are additions to your declared income because there are some adjustments to the value of the transactions with your AE, except for paying tax for that value, there is no consequential change. Now the proposal is, let's say I have sold goods to my AE for rupees 50 crore. I believe profit is rupees 5 crore. Though my books of account may not show rupees 5 crore, I am paying tax on 5 crore. Or I agree with the department under advanced pricing arrangement, or AO makes an addition, I do not dispute it, so on and so forth. 2 things will happen now. One, if you accept your income is 5 crore, you will have to record in your books of account, meaning thereby you will have to suffer MAT if you are otherwise liable under MAT. Second, an impossible requirement is your A will also have to show that particular transaction in its own books of account at this value, how would assessing officer sitting in Ahmedabad will find out or would have a control over assessing officer sitting in Singapore or in New York as to whether that Singapore entity or New York entity has passed accounting entry? But we believe that our officers are all powerful. So this officer will ensure that that officer will ensure that that SSC has passed accounting entry. And if you do not recover the money on account of this adjustment, it's a notional loan on which you will have to pay tax as a notional interest. This is going to work out slightly complicated manner, but this is one change. Those who are concerned with international taxation may have to reckon this problem. Second problem is thin capitalization. Today, if I want to start a company in India which is AE of a foreign company, even though I may require 100 crore of rupees, I may have a capital of 1 lakh, rest I can still borrow with interest. There is no law which prohibits me. Government says that is not what we will permit you, because you are then passing on lot of your profit by way of interest. Put it very briefly, the amendment is that total interest payable by an SSC to its AE cannot exceed 30% of EBITDA. So find out what is your earning before interest, tax, depreciation and allowances, amortization. 30% thereof is the maximum interest that you will get. So if your profit is 10 crore of rupees, you will not get deduction of interest in excess of rupees 3 crore if it is payable to AE or to someone else where AE has guaranteed. So even if you are paying to a bank of London, if your AE has stood as a guarantor to the London bank, even your payment to a bank would not be allowed as a deduction. Therefore, thin capitalization will now not be permitted, and SSs will have to work out how do they enter into this. Last year, they introduced section 115 BDDA, under which if a person receives dividend in excess of rupees 10 lakh, the person will have to pay tax at 10% flat. But the provision was applicable only to individual, HUF and firm. Now it is being introduced to every SSC except domestic company and a charitable trust exempt under section 1023C, etc. Which would mean there are a large number of people who have done estate duty planning by structure of the private trusts. All those private trusts will now be hit, because all those private trusts, whenever they receive dividend, they would have to pay tax if the total amount of dividend received is in excess of rupees 10 lakh. And in all those cases where estate duty planning or estate planning has been done by having trusts, this is the condition precedent. Normally you will have significant dividend income. So again, the tax net is widened by taxing this dividend, which is, to say the least, most unfair. Companies pay tax on their income, tax number 1. Companies pay tax while distributing dividend distribution tax, tax number 2, and again in the hand of recipient, you tax it for the third time, and to add insult to injury, you don't allow deduction of a single rupee expenditure. So this is, but then this is now being expanded to cover up far more larger number of cases. Tax on sale of carbon credit at a concession rate of 10%. There are significant changes in MET. Let me deal with one. Now MET credit is being extended from 10 years to 15 years, obviously because rate of MET itself is so high, 18.5%, it is near the normal rate, 25 to 30. So differential in any case is so less, people are not able to take benefit of MET credit very soon. So now you allow credit carry forward for 15 years, not for 10 years. But the second change, which is a very, very major change, which itself might require one full day seminar, which I am sure the association will keep it some days, when this year, large size listed companies having turnover of rupees 500 crore plus, they will have to write their accounts in a compliance with Indian AS. There are going to be fundamental changes in the way in which accounts are written, and these fundamental changes will expose them to a far greater tax liability. In order to see that they don't end up paying unnecessary tax, a new mechanism is being devised. It's fairly complicated, but essentially what it says is that all those restatements in the value of assets or liabilities will be ignored for all purposes, either for the purpose of MAT in year 1 or for calculating MAT on a year to year till actually the asset is sold or retired. For the time being, I will rest at this so far as MAT is concerned. Some amendments in search and survey. One, which I do not know why people are really shouting, but one amendment which is clarificatory is the reason why the search was initiated under section 132 or 132A would not be disclosed to anyone. When they were ever disclosing to anyone, I have yet to see a single reason in a single case. They were never disclosing to anyone. Somebody did say, but then what about the High Court? High Court is High Court. High Court is above everyone. And no law of the country, unless there is an amendment in the Constitution of India, can govern the power of the High Court. Therefore, even if they say we will not give it to any authority, High Court will say we are above authority. They are bound to show to High Court. They have been showing to High Court, and therefore, other than High Court, they were in any case not showing. And to High Court, they were bound to show, and they will continue to show. Therefore, this amendment, I believe, is maybe somebody must have thought somewhere, or maybe some tribunal would have said, show it to us, and they wanted to show to the tribunal member, you have no power. Otherwise, this is irrelevant. The second, again, probably is unnecessarily creating confusion and complication is power of attachment. So far, at the time of search, the authorities did not have power of attachment. For the first time, it is being given. And a suggestion is being mooted, this is really drastic. I don't think it is really drastic. Today also, department has a power to have provisional attachment. But the problem is that provisional attachment can be effected only in case of a pending assessment. What is happening is, searches are being effected, or probably they would be effected on information, even in cases where there are no pending assessments. Now, if there are no pending assessments, the power of attachment under 281B would not be available. To cover up those situations, now a provision is being made, even where there are no assessments pending, if there is a search and the authority has reason to believe, and sufficient safeguard is kept, if there is a reason to believe by passing an order in writing, by taking approval of the higher authority for a period of 6 months, there will be attachment. Government is not going to throw you out of your property. You are prohibited from selling the property. But this is one change that is being brought in. Third, government has now found that what is charitable is not really a charity. Therefore, there is a power to survey every premise where charitable activities are being carried out. So far, the power was only in relation to business premises. Government has realized that all charity is being carried out in a businessman manner, and therefore now even to a pure trust, power of survey is available. In assessment proceedings, there are some changes as regards the time frame. I will not go into time frame. Broadly stated, what is today, the AO can frame assessment within a period of 20 months from the end of the year. Assessment year, 21 months is being brought down to 18 months from next year and being brought down to 12 months year thereafter. So on and so forth. There are minor changes. What is of importance is, however, one change which requires consideration. Last year when they introduced disclosure scheme, in the question answer somebody had, I would say, completely nonsensically written that government has a power to reopen your assessment for all earlier years. Disclose, otherwise you have a problem. Now, in order to, so to say, give little legitimacy, a provision is being introduced, which obviously has some bearing. Today, the law is that government has a right to go up to last 6 years, including in block assessment in case of search. Now the proposal is, if there is a search, it applies only to search. If there is a search, and if at the time of search any documents or record is found which leads assessing officer to believe that assessee is in possession of an asset. Asset is also defined as land, building, shares, security, loans or deposit. So assessee is in possession of any asset in specified years. Which is specified year? Beyond 6 years up to 10 years. So you are obligated under block assessment to have assessment for 6 years. But if any asset is found for any of the earlier 4 years in excess of rupees 50 lakh individually or collectively, then for those years for which assets are found, the department would have a right to go under the block. Therefore, let's say search is there, assets are found worth rupees 30 lakh for all earlier 4 years collectively, nothing will happen. Assets are found of rupees 60 lakh only for 1 year, only that year will be covered. Assets are found of rupees 15 lakh each for all the 4 years, all 4 years will be caught. So the condition is 1, asset, 2, 50 lakhs individually or collectively. This is under 153A or 153C. To that extent, the power of search assessment is being expanded, but otherwise it is not extension of search power. There are some minor TDS changes which I don't believe I need to take your time. We are running out of time. Again, for PAN, there is not very major change. If you are paying tax under under the presumptive tax under 44 AD or 44 AD1, ADA, therefore businessman or a professional, now the proposal is you will have to pay your advance tax not by 4 installments but only by 1 installment, namely the last installment. You would not be required to pay any interest under 234C as well. So obviously 234C is also being amended. Government is retaining power to withhold refund under section 241 capital A. Today the law is that if you file your return of income and if there is a refund due under 143(1)A processing, the refund will have to be given to you. I must say I skipped in between for want of time. Now every return will have to be processed. Today the law is that if you are filing return which is being taken up for scrutiny assessment, processing is not mandatory. That provision is being eliminated. Every return will be processed. Now 241A says if your return is processed and if it is found that refund is due to you, if assessing officer finds that giving over of a refund is likely to prejudice the revenue, after recording reasons, after taking approval of higher authority, he has a right to withhold the refund till assessment is framed. In a given case, I would say it's a welcome change. Why? Many times we ask SSS to pay tax out of abundant caution. We say, pay tax, but we will claim in refund in the return. It's better in such a situation that amount is retained there, because otherwise what is happening is amount is received back by you and meter of interest starts ticking. Therefore, you will have to again return the money back with interest. So it's better that they retain the money. Ultimately, you will succeed. You will get back with interest. If you lose in any case, you don't have to pay interest because money was already paid by you earlier. TDS, if you are entitled to refund, now it will also carry interest, which is a welcome provision, because many times people would pay TDS out of abundant caution, especially payment to non-resident, and then ask for refund. Now the law is that it is being refunded to you with interest. The Honorable the Chairman said about hidden opportunities, and I'll end with this note. A proposal is being mooted by the legislature, which is reflecting a very sorry state of affair, but we must acknowledge it in such gathering. Only then we will be able to deal with the problem. Section 271J is being inserted, which says that if any assessing officer or CITFP finds that any report or certificate given by a chartered accountant, given by a merchant banker, or given by a registered valuer contains incorrect information, or the certificate gives data which is incorrect, then such chartered accountant, merchant banker or valuer shall suffer penalty of rupees 10,000 for each such report. There is bound to be at times genuine dispute between the accountant, valuer, etc. and the department as to whether the certificate is right or not. But then this is one area where litigation might start, and the problem is this is not an appealable order. So every order, either you suffer or you file a writ petition in the High Court. Therefore, this is one thing which must make every chartered accountant careful to be sure that you are never accused of giving a report which can suffer at the ends of the assessing officer under section 271J. With this, let me close today's talk. I'm aware that I have skipped some of the interesting issues, but then I would have been far beyond the time allotted to me. As I said, this is interesting budget. We are passing through interesting time, and government has called upon every citizen, every taxpayer and every professional to do its own might. I am sure that we will stand up to the challenge and will do very well. Thank you very much.
Before I propose my vote of thanks, one announcement for all the members. The sales counter of budget booklet is just at the entry gate. So even though if you have not booked your copy in advance, you still can purchase the books from the sales counter. And the booklets are in English as well as in Gujarati. So thanks to the publication committee for this facility. I am also acknowledging the presence of Swati Soparkar ma'am. And now coming to my duty, on behalf of Ahmedabad branch of WIRC of ICI and CA Association Ahmedabad, I propose my heartily vote of thanks to Saurabh Soparkar sir for accepting our invitation and enlighten us on the topic of Union Budget 2017. Now I request Chairman of Ahmedabad branch CA Vikas Jain to offer a memento and bouquet to Soparkar sir as a token of our love and affection. I am also thankful to Karnavati Club for this venue and other facilities, and special thanks to Durgesh Butt sir for helping us to get this venue and other facilities. And I am also thankful to all the members for attending. Thank you. Good night.